So we'll get started. The goal of these webinars, I know everyone's very busy, so we try and keep them concise within the 30-minute window, and obviously allow you guys to ask as many questions as you'd like. But we know everybody, wants to get going on their day, and webinars in the world of Zoom, it can be mind-numbing to sit in front of a screen for multiple hours and things like that. So we'll cover a lot of stuff very quickly and go from there. And if you have questions, obviously you can always just pop them up in the chat and go from there. So, all right, and then it looks like we have one in New Hampshire. So, all right, perfect. So let's get going. So one of the things I hear all the time, people that want to retire, I'll say, who do you want to sell to? And everyone says they want to sell to another dentist or to an associate who's going to be a first-time owner. And then I ask, who do you think you'll sell to? And pretty much everyone says they think they're going to have to sell to corporate. And that's not always the case. Is there certainly times when it makes sense to sell to corporate? Yeah, absolutely. And there's corporations or DSOs that do a great job partnering with dentists long-term. But, a lot of times the dentists I talk to are one doctor practices and they want to retire and not do dentistry anymore. And part of a corporate transition, 90% of the time, is that you have to stay on and work for a couple of years, and then you're an employee of someone. And, everybody has heard horror stories or, tales from friends or colleagues that have done it and not been happy. The perception is with rising student loan debt, among other things, that associates can't buy or they don't want to buy. So again, which could be further from the truth. So what we'll cover today, obviously, my name's Dave Miller. I'm the managing partner of Rosen Dental Transitions. My history is I was in the banking world doing dental transactions for Bank of America for a long time. And we were always financing first-time buyers. Sometimes there were doctors, purchasing a second or third office, but I would say over 75% of the transactions were people that were associating and were going into their first venture of practice ownership. So it gives me a deeper insight into what do those buyers want, because I was working with them for so long, and what does it take for them to get financing? What are the other lenders out there? There's several dental-specific lenders that specifically design programs to give money to young dentists who have $400,000 in student loan debt and not a lot of money in the bank. There's Bank of America, TD Bank, Avidia Bank. There's finance companies like Provide, Practice Pathways. Some of the other local ones, obviously Wells Fargo is in that space. And there's other banks in the area that, depending on the state you're in, that may do it. Androscoggin Bank, there's Webster Bank. There's banks in different areas that all have found a way to make these safe loans. And the reason is because dental practices rarely fail. So they're willing to do lending programs that they wouldn't do for a pizza shop or, a retail store or a new restaurant. Just a real quick recap for those of you that may or may not be Rosen clients. Obviously, Rosen and Associates is the accounting firm. They service over 800 dental practices across the country, obviously mostly concentrated in the New England area. We have a large, obviously, population of practices in Mass. We have over 300 dental clients in Connecticut. I'm not sure the exact number in New Hampshire, but it's spread all over the states of New England, even into upstate New York. You have Rosen Summit Dental Advisors. That's our consulting team, formerly Summit Advisors, which was Nancy Kagan and her team. They merged with Rosen. Their group does outsourced billing. So I know a lot of people have problems with accounts receivable and posting payments and unpaid insurance claims. They have an outsourcing department where you can outsource that. And then they also do in-office practice management where they, teach front desk people how to work more effectively, work with owners to manage the business better, things of that nature. So, and then there's Rosen Dental Transitions, which is my group, which specializes in valuing dental practices and then helping people transition into retirement. And that could mean a lot of different things these days, just based on all of the different options for who you could sell to. Just to give you kind of the Rosen umbrella of companies, there's also CCR Wealth, which is financial wealth management, which is kind of the fourth side. So I think the number one question that probably the elephant in the room is like, well, am I going to lose money by selling to an associate instead of a DSO? In my opinion, and I think there's a math problem that would back this up, no. And there is maybe one exception to that, which I'll cover at the end. But most times in a DSO, you have to work for 2 years after you sell, and you're an employee at that time. So you don't have the tax shelters you normally do. You're not getting the profit of the business. So you're getting paid as a W-2 employee. And my argument would be is that if you just owned your practice for 2 more years and sold the practice to an associate and then walked away, you would make more money than if you look at what you sell the practice for and then what you would do for the next 2 years as an employee, as an associate dentist getting paid, 35 to 40% of collections net your lab expense, right? So I think sometimes everybody hears these stories of, oh, I got, 10 times EBITDA or these crazy multiples. But what the corporations and DSOs are doing is they're heavily weighting those offers with equity. And so that's the kind of that's the debate point that a lot of people have of, well, if I get equity in the company and it continues to grow and then they sell out to some huge corporate, I'm going to get a big windfall of cash. Maybe you will, maybe you won't, right? And depending on the corporation that buys you in their position, that equity could maybe feel more stable or safe, maybe a younger growing group. But I think that's the only thing that is an unknown. And, from my perspective, if someone said, hey, I'm going to put $1 million tomorrow in Apple stock, okay, maybe, but I don't know if I'd feel comfortable doing that. And that's Apple, right? Like, what about a company I don't know much about that's only existed for 3 years, that's, rapidly growing and acquiring? And, so again, I think the math supports that if you laid out your earnings as an owner from your associate, your income, your profit, all the tax write-offs for 2 more years and walked away and sold for a fair market price, you would have more money after taxes than if you sold to a group and stayed on for 2 years. And there's nuances to that, but I think that's important to cover because a lot of people are afraid they're going to leave money on the table if they don't sell to a corporate buyer. So what are associates ideally looking for when they're buying practices? And this is ideally. It's not to say that if your practice doesn't meet this criteria, there's not a buyer for you. This type of practice is going to have the largest buyer pool out there. And the larger the buyer pool, the higher price you can command, the more competitive the market is. All those common sense things you see in the housing market apply to the dental market, just not at the same degree. So they don't want to take a pay cut to become an owner. And what do I mean by that? It's if your practice is doing $750,000 and there's $500,000 worth of dentistry to be done, I'll pop up a calculator. If you were to say I bought your practice and I had to pay an associate 35% of net collections minus their lab, they're going to make roughly $170,000, right? That's the cost of employing that person. So your business better have more cash flow coming through it than $175,000, because if not, they're paying the loan with their associate income, with essentially their W-2. And an argument could be made, why would I take on the headaches of ownership if I'm going to make less than I could clocking in and out of a practice 4 days a week and I don't have any of the problems? I can just show up, see patients, and leave and enjoy my weekends. So that's one thing to consider. And if you have a really small practice, we'll talk about that. It's not as much about cash flows as the opportunity of cost of if someone wanted to start from scratch, or maybe is looking for a growth opportunity, what's the opportunity cost comparing, acquiring this practice versus going out on your own. The other thing they're looking for are turnkey practices. I will say this with the caveat that if you're planning on selling in the next 6 months, maybe it doesn't make sense to go out and spend $150,000 on equipment. If you're still developing films on plates, or you have a PeriPro, or you don't have digital X-ray in your practice, that's an investment that the buyer views as non-negotiable, right? In their mind, in order to practice dentistry the way they know how, which is from dental school or wherever they're at, is to do digital X-rays. So they view it as I have to buy the practice and I immediately have to invest in technology. So again, just something to consider, that if you don't have it and you're going to sell right away, maybe don't buy it, but just expect that could impact the sale price of your business. 4 ops or more. Again, not to say smaller practices can't sell, but a lot of associates want to buy a practice so they can eventually grow collections to $1 million. And doing that with 3 ops or less is really challenging. So having 4 ops or more, or the room to expand to 4 ops within the existing footprint. So maybe there's 3, but there's a 4th room plumbed and it's being used as an office, or they're selling the building and there's room to add on the back. All of those things matter to show capacity for growth for the practice. A reasonable commute. The more rural your office is, the harder it is to find a buyer, just simply by factor of supply and demand. again, doesn't mean you can't find one. You just need to plan for a longer timeline for the transition, because it's going to take a lot more marketing and networking to find that person that wants to live in your community and own the practice as well. One of the reasons, it's not shocking, that practices inside 495 sell for much more than one in northern New Hampshire or western Mass is just simply by the fact that there's so many buyers that you can start a bidding war and get more than the practice may be worth. The other big thing is performing procedures you currently refer out. So if you're a restorative dentist that refers out all your endo and perio and you're not really doing much in-house, that's a huge upside to the buyer. So if you're profitable because you just have a strong hygiene and restorative practice, a lot of these dentists are able to, they at least restore implants. Some of them place them. A lot of them are doing simple endo, or maybe they're trained to do perio, or they have, they can bring a periodontist in to do stuff. So also a great sign for someone who's looking to buy a practice. The last and most important thing that kind of ties into the first one as well is cash flow to pay the loan. If someone buys your practice for $500,000, right, they're going to have to pay a loan of roughly $60,000 a year. So that means that your practice has to be able to pay the dentist fair compensation for the dentistry that is done. So again, back to that example of $500,000, that's about $170,000 in W-2 income to the dentist. So beyond that 172, if the loan's going to be $60,000, there has to be more than $60,000 in order to get a price of $500, right? Because there has to be cash flow to pay the loan and pay their taxes. And the other thing, again, you could argue is that beyond paying the loan, if there's any excess above and beyond that, consider that almost like a management fee, right? 1 or 2% or 3% of collections to say, you're compensating the new buyer for having to run a practice. Now, again, there's a lot of what about this and different scenarios of, well, there's so much growth but think about it. When you buy a house that's a fixer-upper, you don't pay for the house. You don't pay the price for the house of what it's going to be worth after you've put in all the hard work and renovated and gutted and put in new bathrooms and added onto the back and added square footage. You don't buy the house for what it's worth after you invest the time and the money. You buy it for what it's worth today. So I think that's sometimes what we see sellers struggle with is, hey, 3 years ago I was doing $1 million and I've just cut down to 2 days because I'm getting ready to retire. And, so the practice is only doing 500 now, but it's easily $1 million practice. Well, that's fine, but buyers aren't going to pay for that potential because, one, you don't know those patients haven't gone to other places, right? If they can't get in to see you at convenient hours, they may be going to other dentists. Two, the banks aren't going to finance it. So the buyers don't have cash to buy these practices cash. There has to be cash flow in the business to pay the loan back. So, you can't have a practice that collects 500 and make the argument that it should be collecting 750 or $1 million and then charge 650 for it because, one, the buyers are too savvy for that, and two, the banks just aren't going to approve the loan. So you can't get anywhere if the banks aren't going to approve anything. So that's, again, just really important to keep in mind as we start going through this is, cash flow is king. So that's the most important thing. Number 6 is our most important item of having cash flow. And then the other qualitative things like turnkey practice, is there wood paneling on the wall and carpet in the ops, things like that. That's what's going to move you to the higher or lower end of the sales price because the buyers are going to view it as immediate investments that need to be made when they come in. So your practice is worth $650, but I have to buy digital sensors and I have to upgrade the servers because the computers are old and they can't handle the new, digital imaging software. And, there's wood panel on the walls and carpet in the operatory. So I need to give it a facelift. So that's, $50,000, $60,000 right off the top that I'm going to take off the price. Just, again, all to have good expectations and have things under consideration when you're thinking about selling. One thing is when you're thinking about transitioning, the size of your practice dictates how you should prepare. So you're all GP practices. Are you a 1-doctor practice or are you a 2 to 3 or a 4? Because each one requires a different transition plan. And we're going to start by covering things that, everyone should do regardless of the size of their practice. And then we'll get into some of the more specific by size and scope. I know we covered some stuff. Any immediate questions or anything that's come up so far? If not, no big deal. But if you have any, like I said, feel free to, pop it into the questions on the side. We can address those as we go. All right. So regardless of your size and specialty, there's certain things that you should make sure that you take care of as you're leading up. One is clean up your books. As an owner, you can make decisions about what you report as income and cash that's under the table and things like that. But we can't go to a bank and say, hey, I know this practice collects 650, but there's easily another 100 grand that we take in cash that we don't report. The bank's just never going to take it, and just view it as you got away with it for this long and didn't have to pay taxes on it. You're not going to be able to get it on the back end with the sale. You already got the benefit of sneaking that up. So, clean up your books. If you run a ton of personal expenses through the practice, we adjust when we value your business. We pull out 90% of those to adjust and show the profit. So things like personal insurance, you have kids on the payroll, maybe you have a significant other on the payroll just so you can fund their retirement plan. Maybe you own multiple commercial real estate and you run some of your, operating expenses through this. So those things we can identify, we can document them, and we can adjust your cash flow to say, listen, the owner does this because it's lowering the amount of taxes, but this is really cash flow through the business, right? Meetings and meals is another one that's obvious. Travel and CE, like if you go to the Bahamas for your continuing education or to Hawaii and you spend a lot of money on that and use it as a tax write-off, we add those back because the buyer doesn't have to do that. They could go to Yankee or they could go to the local, district. So we adjust for the obvious expenses. Where it's really difficult for us to make adjustments is, I have my Amazon account and my Costco membership all tied to my business credit card, and I run $20,000 a year through that and put it as office supplies. Well, that's fine, but it's hard for us to go through your general ledger and distinguish everything that's personal from the business, especially with people ordering more and more things off Amazon for the office. So if there's some of those things that are kind of sprinkled throughout that are very, very tough to document, I think that's the key. Think about if we're going to use that cash flow to get the bank to approve a loan for a buyer, we have to be able to prove in writing that that's a personal expense or something that's discretionary. So like I said, the obvious ones we talked about are you probably have, personal medical insurance, even maybe your family's medical insurance, life and disability insurance, retirement accounts, your car that you write off with your practice. All of those are very straightforward, easy to adjust for. The ones that are more challenging are when it's buried in office supplies. And if it's a small amount, don't worry about it. If it's $1,000 here or $1,500 there, not a huge deal. But if it's $20,000-$30,000, that's a meaningful amount of cash flow that you can support. Think about this: every $100,000 someone borrows from a bank, that's $12,000 a year in a loan payment with today's interest rates. So if you have $25,000 worth of expenses that are hard to document, that we can't use in the cash flow to show how profitable the business is, then that's potentially $100,000 off your sales price, right? So again, just get them cleaned up to the best you can. From a lending perspective, banks usually look back 2 to 3 years. So we always say clean up your books 2 to 3 years before your potential sale if you can. Again, if it's not incredibly messy, not a big deal. Talk to your family and advisors about retirement, and if you're ready personally and financially. Talk to your spouse. Like, what are you guys going to do with your time? Are you going to drive each other crazy if now you're home together all day? Financially, if you sell and walk away, how much is in your retirement? Do you have to work after the sale to generate some income? Do you have any other income producing properties? There's nothing worse than talking with the seller, going through the transaction, getting an offer, everyone's excited. Then 2 weeks before closing, they meet with their CPA, and their CPA says, well, you're getting $1 million, but you have $250,000 in debt from the renovation and equipment you did 5 years ago. You have a $30,000 line of credit, and you have to pay taxes. And so for that, you're only going to walk away with about $450,000 to $500,000. And the seller's like, why? I can't live off that. I thought I was getting $1 million. It's like, well, no, that's not how this works. So make sure you talk to your family about your personal life and what you plan to do, and make sure that you can be happy. Some people love to work. And so when they walk away from that and work kind of defines them, there's a void that can be tough to fill. And then financially, make sure that you have that under control. have someone give your practice a full mouth exam. So there's three main areas that dramatically can change the value of your business and what you walk away with at the end of the day. So one, what we like to call profit leaks, unpaid insurance claims, and accounts receivable. So staff is stretched thinner than ever with what's going on with COVID, staffing shortages, etc. And what we find is unpaid insurance claims where, for whatever reason, the insurance kicks it back. There could be a multitude of reasons why that happens. It's a lot of work to get that straightened out. You could call the insurance company and sit on hold for 45 minutes, and you have to get to the right person and documentation, and then you finally resubmit it the right way. Well, we call that hard money to find. And that's at the bottom of the to-do list because your front desk or, scheduling coordinator has so much to take care of that, they're not going to be able to get to that right away. So make sure we look, there's reports you can pull to see unpaid insurance claims over 30 days, right? You can Google it if you can't find it on your own, or we're happy to help. We do this for practices all the time. Accounts receivable audit, obviously looking at the health of your accounts receivable, what the amount should be, and how much is over 60, 90 days. The liabilities. So patient credits is a big problem. They could be 7 years old. Someone has $8 on their account and you never sent them a refund check or forgot to get applied to future service. Could be a million things. Well, those are liabilities to the buyer. So if you sell your practice for $1 million and you have $100,000 in patient credits because they've never been cleaned up and never looked at, then $100,000 comes off the sale price, right? Because if that buyer takes over your practice and that patient comes back and says, hey, you guys, I have a balance of $20. I want that money back. They have to give them the money. And you've already collected that, put it in your bank account. So, best case scenario, it's just posting errors and you can go through and clean it up and you realize that money wasn't allocated correctly. Other options, you can, make sure that when patients come in, you apply those credits to future work and just let them know. And then the last thing is ultimately you would have to refund them. So again, something to make sure you look at. And the other one is posting errors, seeing how things are posted in terms of, doctor versus hygiene. We see it a lot. Oral exams should not be posted under the hygienist. Compliance wise, hygienists can't do doctor procedures, which is what an oral exam is. And, from a compensation standpoint, if you're paying associates or paying yourself based on adjusted net production or collections, having the oral exams under the hygienist is going to dilute the compensation and you're going to be paying people incorrectly. So the third one is the growth opportunities. The hygiene program, specifically how much perio is being done out of hygiene. If you don't do a lot of scaling and route planning, ideally more than 20% of the hygiene production should come from a perio program. And then the other is the unscheduled recall and treatment. Again, pulling reports to see how many people were due for hygiene this week that didn't get on the schedule or didn't come in. How many people were last month and the month before that, and how many are in the month coming up. These are incredible growth opportunities. Again, it just goes back to staff being stretched so thin that they're, chasing down insurance claims, rescheduling, dealing with all the COVID nonsense. And it impacts their ability to fill the schedule the way they should. So again, this can all be done in 2 hours via a Zoom meeting, just going through the practice management report, and you can just identify what the problems are. And we're happy to help if that's something you'd want to do. I'm going to try and speed up a little bit since we're at 10:30 already. Understand how the real estate will impact the sale. So if you own the real estate and you're selling to an associate, some of the associates will not have enough cash to put forward the down payment on the real estate at the same time they buy the practice. So even though they don't have to put a down payment on the practice, the bank still wants them to have money in the bank to make sure they're not, living paycheck to paycheck while they're also paying $1 million loan for a practice. Obviously you can sell to the buyer. Most common scenarios that you rent to the buyer with an option for them to purchase in the future. So maybe you have a 3 to 5 year lease and the buyer buys the real estate down the road. The other option is if you really want to cash out, you could sell it to an investor that would then rent it to the buyer. That's an option. The last scenario is, you could finance the down payment for the buyer. So if your building's worth, $500,000, a 20% down payment would be $100,000. The buyer would have a $400,000 mortgage on the building to the bank, and then they would pay you monthly $100,000 at an interest rate that matches the bank rate. So that's a way to unload the building, and then you would just finance the down payment. If you currently rent the real estate and you don't own it, the one thing I cannot stress enough is find out when your lease renews and try and take a run at renegotiating that. And I wouldn't do that on your own. There's realtors that specialize in dental, like car, healthcare, real estate. They specialize in doing lease negotiations. It's a little bit of a game of chicken with the landlord, but what usually happens, especially in rural areas, your lease goes up every year or every 5 years, and your lease rate outpaces the market value of the market rate of leases. So you could be paying $20 a square foot when market rent could be 17. And so negotiating that back down to fair market rent is important. The other thing is, if you've been in your space for 20 years and the landlord's never reinvested in your space, you may be able to get them to pay for new carpet, lights, and paint, and that could give you the facelift that makes your practice more attractive without you spending a dollar. Think about from a landlord perspective, most tenants turn over. They're not there for 20, 30 years like a dental office is. And so every time a space turns over, they have to repaint the space, put new flooring down, maybe, do construction. So there's always a cost. They have to hire brokers, et cetera, right? So there's always a cost associated. So there's an opportunity for you to renegotiate if you take the right posture and stance and handle it the right way. The biggest thing is timing. If your renewal is 1 year from now, you need to start negotiating today on your renewal. If you do it 3 months, 90 days before your renewal, you don't have much leverage. So going by size, if you're one doctor practice preparing to sell, try and sell before you let your collections decline. I know it's as you get older, you scale back your schedule, you don't do as much. And if you're set financially and you don't mind selling for a lower price, then that's okay. You can do that. But again, just goes back to the example of, you can't say your practice used to do $1 million 3 years ago, and it's only because you cut back your schedule. And now you still expect to sell it like it's $1 million practice. It just won't happen. Understand your excess cash flow. Again, that's the cash flow going through your business after you pay the dentist fair compensation for the dentistry they've done. So take your collections at the end of the year, multiply it by 35%, and subtract that from what you made out of your business. And that excess is a starting point for how much cash you have. And then the last is, understand how much you'll take home after debt and taxes from your accountant, so that if you're selling your practice for $1 million, you know how much you're going to actually walk away with. 2 to 3 doctor practice preparing to sell. The first is, how hard are you to replace, right? If you're a mega producer that produces 1.8 million yourself, a buyer, it's going to be very tough to find a buyer that can step in and do that level of dentistry that is also lives in your town and wants to buy a practice at the same time you want to retire. So hopefully one of your associates in the practice can fill the shoes, or maybe a couple of them can, but trying to, give your associates the ability to produce will be big. If you are that unicorn that is a super GP that does restorative and implants and perio, and you're closing all on 4s and full arches, that's a very, very tough practice to sell because you're looking for a very specific buyer. Not saying you can't, but it's just going to take longer to find that person. Talk to your associates that, when you hire them and before you want to sell, preferably a year or two, to see if they're interested, so you can start having the conversation. If you talk to them, while your practice is on the market and they don't want to buy, now you're at risk of them potentially quitting because they may be afraid of working for whoever the new buyer is, or that they might lose their job. So talk to them early on and just say, listen, have you ever had, aspirations of ownership? Eventually I'm going to retire. I'm not retiring tomorrow or this year, but, would you be interested when the time is right to have that conversation? And just get an understanding, because buyers are going to ask that. Hey, why isn't the associate buying the practice? And you want to be able to say, well, we've had that conversation. They just don't want to be an owner. They like being able to come in 4 days a week and clock in and clock out. Be flexible in the structure of the transaction. As the dollar amount gets bigger that the bank has to lend, they may ask you to participate in the financing, or you may have to split it over some time with an earn out. So if you're getting 2.5 million, the bank may say, listen, this is a big loan. There's a little bit of risk because, Mr. Seller, you're a huge producer. I know you're going to stay on to transition the new buyer, but we want you to have some skin in the game to make sure that that's going to work. So it's 2.5. We'll give you 2.1 up front, but the other 400,000 we're going to ask you to finance at the same rates that we are, 10 years at 4% or whatever it may be. So again, that's a way that the bank and the buyer make sure that you'll ensure a good transition, and you won't quit after 90 days and the practice drops by $1 million in production because they can't backfill your spot. If you're a 4-doctor practice, I think what's really important is having management structure. If it's you and your significant other that do everything, and then when you retire, you're both going to walk away, that's a huge gap and risk for the buyer that's going to, impact their ability to sell, purchase. I always recommend start a phased buy-in process 3 to 5 years. Think about it. The first chunk of the buy-in could be small, and that's like the flight taking off. And then, while you're in the middle of the air, you're going to buy in for another portion. And then when you finally land, they're going to buy the last 30 or 40%. A lot of that is because if your practice is collecting $5 million and you're going to get $5 million from the buyer, the bank's not going to be willing to outlay that much on the first go for a first-time buyer. They're going to want to see, someone who's been in the practice, is a big producer, has cash, and that they, own a portion that's going well, and then they can kind of take it in chunks. It's very difficult to get it financed when your practice is collecting $4 to $5 million for a first-time buyer. What you could do is, if there's another doctor who owns a practice similar to yours, and they're out there, right? Maybe they own 1 or 2 offices and they want to buy a third, and they have a track record of operating a large practice, the bank will give money to them. But if you're trying to sell to the associate in the practice, I really recommend planning ahead and trying to do a phased buyout. And again, start shifting production to your associates and partners. It goes back to the unicorn comment earlier of being a huge producer. You want to make sure that the associates in your practice are going to be buying the practice are doing a big chunk of the production. It just goes back to how big of a gap there is to fill when you finally retire. And if you're doing a phased buy-in approach, that'll probably occur naturally as you start to cut back days and make your lifestyle more retirement friendly. But again, just something you want to consider on a practice that size. It takes much longer to transition it to an associate who's a first-time buyer in that scenario. So I know we covered a lot. I ran 10 minutes over, so I apologize about that. Are there any questions or anything that has come out? Obviously, if you have any questions at all, you can always email us and reach out. I was going to see if I can throw up a little form, so that way if you guys want to talk to me directly, phone calls are free, right? So I'm happy to talk through if you think you have a unique transition scenario, something that would be worth a deeper conversation. I'm always happy to do that. Yeah, and then so one thing we do, I'll offer is that we do what's called a simulated sale, and I'll give a handout, an example of that right now, and you can download it if you'd like. Part of it is knowing what the value of your business is, and also what's driving that value and how do you grow it. So if you look at your excess cash flow today and you don't have a lot of cash flow in your practice, how do you generate that and create it? And so we have a process where we go through and say, all right, here's what your practice is worth now. I'm going to share an example of one that you can download if you like. It should be, again, on the right bar where the chat is. It says, all right, what's driving the value of your business and where are those profit leaks that we talked about in terms of where you may be losing money, where are the liabilities, and how could we fix those? And then we can even go deeper and say, all right, from a market perspective, where's your digital brand? Where's your website compared to your competitors? What are your competitors doing? Where are your new patients coming from? What's your immediate market that you're drawing the most, 80% of your new patients from? And what does that competitive landscape look like? It's a really robust process. And then if you go to sell with us, the amount you spend to do that simulated sale is a credit towards the commission we charge when you sell. So it ends up being no cost if you sell within, basically we say if you sell within 5 years of doing this. Again, a great exercise to get an idea of what your practice is worth and how to grow the value more importantly. So if you, again, have any questions, always just let us know. My email's right there on the screen. And, we're happy to help in any way we can. Like I said, just let me know if you guys have any questions. But if not, have a great day and, enjoy your weekend.